Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending May 5th, 2023. Looking at the market indexes for the week, the TSX, the S&P 500, Dow Jones, and Russell 2000 were all down. NASDAQ was the only major index up for the week, mostly on the strong Friday. Gold was up, oil was down to $71 per barrel for the week. The price of WTI crude dropped over 5% just on Tuesday to a 5-week low on worries about a potential U.S. debt default, weak demand from Asia, and weak U.S. economic data. Oil is still bouncing around. There's also worries about U.S. regional bank defaults as additional U.S. regionals like Pacific Western get into trouble. Commercial real estate being weak, with offices remaining under-occupied and possibly defaulting on its loans, and lower loan volume in general as banks lent to low-risk customers only due to the bank failures in March. Starting with Canada, the unemployment rate in Canada on Friday came in at 5% for April, same as the previous month and lower than expected. Suncor doubled down on the oil sands last week. The 56 billion Calgary-based energy giant watched its stock price rise after announcing it would buy a French competitor's Toulder Energy's oil sands assets for as much as 6.1 billion. The timing isn't exactly horrible, with OPEC Plus set to cut production by 1.16 million barrels per day this month. Oil prices, like oil profits, seem unlikely to drop, likely sending even higher dividends to Suncor investors. CN, Canada's largest railway, reported a 16% rise in quarterly earnings last week, raking in a total of 4.3 billion, largely thanks to last year's bumper grain harvest. But here's the thing, shipments of stuff that isn't grain are way down. In an earnings call, CN execs said shipments of consumer goods, furniture, clothing, etc., dropped 13% by volume in Q1 year over year, which in their view suggests the economy has entered a mild recession. But I would argue the economy is trending towards higher demand for services rather than goods. Relatedly, fewer container shipments from abroad are entering Canadian ports, according to another railway, the Canadian Pacific Kansas City. That said, folks are still spending money. Visa reported that payment volumes rose by 12% last quarter, which nudges its revenue up about 11% year over year. MasterCard's revenue rose a more impressive 14% year over year, which CEO Michael Maybach said was mostly due to travel purchases. How can you have higher payment card revenue but lower goods shipments? The answer is probably higher prices. TD walked away from its purchase of the US First Horizon Regional Bank following First Horizon's price drop. This is a good idea, and they can wait or reset the purchase price. The purchase would have made TD the sixth largest player in US banking. There was some resistance from US regulators as well. The TD share stayed steady afterwards. Turning to the United States, the Federal Reserve raised interest rates by 25 basis points to a range of 5% to 5.25% on Wednesday, the highest level in nearly 16 years. Also, the central bank statement softened somewhat from March, indicating that the Fed may pause rate hikes at its June meeting. Federal Reserve Chairman Jerome Powell stated that policymakers would take a data-dependent approach in deciding on the federal funds rate. At the same time, Powell ruled out cutting interest rates because inflation was still not expected to come down quickly. The Fed chief also said that, quote, conditions have broadly improved, end quote, in the banking sector since March. Unemployment rate in the US on Friday came in as 3.4% for April, lower than the previous month and lower than expected. The US economy is still looking strong despite the well publicized but tiny tech company layoffs. Last week's higher than expected US PCE inflation measure was accompanied by quite a miss on the Q1 GDP growth, raising the possibility of stagflation, where the US has a slowing economy, yet inflation remains stubbornly high. At the same time, however, the weekly jobless claims data pointed to a still robust labor market, which continues to keep the US out of a recession. Together, all this illustrates the unusually wide range of plausible macro outcomes for the US economy. The inflation has two sides, a supply side and a demand side. The central banks and the interest rate increases will only affect the demand side, bringing spending down. They cannot affect the supply side issues like supply chain issues, which have decreased but have led to more local production with onshoring, nor the wage inflation, which has been happening due to COVID and the free government support during COVID, nor international issues, which have led to friendshoring and higher commodity costs like the price of oil. Job openings declined to 5.59 million in March in the US, lower than the expected 9.7 million, and are an indication that the labor market may be loosening with fewer jobs available, and wage inflation may fall off some. The current Q1 earnings season is halfway over, and so far it's been fairly positive. Nearly 80% of companies that have already reported posted profits that topped Wall Street's expectations. Likewise, profits have declined less than feared. Much of the relative strength has come from tech companies such as Meta and Microsoft after a brutal 2022 for Silicon Valley and the NASDAQ. Likewise, the slowdown in consumer demand has been moderate, and companies have made up for the lower sales volumes by raising prices, which customers have been willing to pay so far. The upshot is that while central banks have had to raise interest rates to slow demand, it hasn't yet hurt companies' bottom lines much, which is not what usually happens. The question now is, will a moderate slowdown in demand be enough to bring down inflation? Companies are surely hoping so. Or will inflation refuse to fall and force the central bank to keep hiking rates and perhaps drive the economy into a painful recession? Only time will tell, of course, but at the moment, the latter scenario looks to be the less likely of the two. A drop in ad sales is one of the telltale signs of a recession. So it's notable that Google reported a 3% rise in overall revenue and a 2% uptick in search ad revenue over the last quarter. More surprisingly, Meta, which had seemed almost doomed at points last year, shocked Wall Street last week when it posted a 4% rise in ad revenue in Q1 year over year, which drove up its stock price an improbable 15% on Thursday. If companies were seeing storm clouds ahead when it comes to consumer spending, they'd be slashing advertising and stashing that cash, but that doesn't seem to be the case. More than 5% of the S&P 500's year-to-date gain of 6.6% is from the 7 tech giants, with only 1.28% of the index's gain for the year so far coming from the other 493 stocks. This narrow market breadth is quite risky since the undiversified market gain can come off just as easily. JP Morgan bought First Republic Bank over the weekend, which had previously been taken over by regulators and was the fourth US regional bank to fail since March. Because of the cheap price, JP Morgan got a great deal and did very well on the purchase, increasing its customer base. JP Morgan acquired about 173 billion of First Republic's loans, 30 billion of securities, and 92 billion of deposits. JP Morgan CEO Jamie Dimon said the deal would help stabilize the banking system. The banking crisis in the US is deemed to be over, but has left a lower lending level behind, which is a drag on the economy, but also reduces inflation. Speaking of the crisis being over, another U.S. regional bank, Pacific Western, got into trouble this week, and they are looking for a potential buyer or investor. The problem started in the stock market with short sellers, which made the stock price go down, worried the clients who started pulling their money, which caused further share price falls, etc., etc. Some ways to deal with this would be to ban short selling on banks, which is market manipulation by the government, or backstop all deposits, which leads to a moral hazard by the bank since they can take whatever risks they want in their investing, knowing that they'll be bailed out by the government. As the economy weakens, however, banks that weren't capitalized well already will have even bigger problems, along with the tighter credit conditions, which will eat into loan growth. Everyone, meanwhile, is trying to avoid the word, quote, systemic. I have avoided the US debt ceiling issue so far because it is political, pointless, and dysfunctional, and always gets temporarily resolved in the end. However, since we're now in May and experts refer to it more and more, and it's spooking the markets, let me say the following. If the political posturing prevails for some more weeks, then we could reach the end of May with a growing nervousness about whether a bill to suspend the debt ceiling until the fall would pass Congress in time to avoid default. Equity market volatility would rise. In theory, a threat to creditworthiness of federal debt should boost Treasury interest rates and depress the dollar. However, the traditional safe haven role of both treasuries and the dollar make this effect less certain. If, in an act of unprecedented recklessness, Congress fails to increase or suspend the debt ceiling in time, the Treasury will likely miss an interest or principal payment on the debt. This event would likely precipitate a major stock market meltdown, a spike in Treasury interest rates, and a collapse in the dollar. A further downgrade to US debt would probably occur. After a few days of chaos, Congress would likely suspend the debt ceiling for a period and get back to negotiating the budget. However, some default risk premium would likely permanently be added to US Treasuries, and the uncertainty caused by the crisis would increase the likelihood of a near term recession. For investors, it may be tempting to move to the sidelines while debt ceiling uncertainty remains. However, it should be recognized that this situation will eventually be resolved. Partisanship in Washington could push the federal government to the brink of default, or in worst case scenario, actually default. However, members of Congress won't have the stomach to perpetuate a fiscal crisis and recession if, by the simple act of suspending the debt ceiling and kicking the can down the road as they have always done, they can provide relief to their constituents. The passage of such a bill should cause a rebound in the stock market, although some damage to the dollar and the Treasury bond market may be permanent. Across all of these outcomes, the only potential common thread is a decline in the dollar, and investors may want to make sure they have good exposure to the bonds and stocks of other developed economies denominated in foreign currency. Now for some bits and pieces. Global sales of electric cars are set to surge to yet another record year, expanding their share of the overall car market to close to a fifth and leading a major transformation of the auto industry that has implications for the energy sector, especially oil. The latest edition of International Energy Agency's Global Electric Vehicle Outlook shows that more than 10 million electric cars were sold worldwide in 2022, and that sales are expected to grow by another 35% this year to reach 14 million. This explosive growth means electric cars' share of the overall car market has risen from around 4% in 2020 to 14% in 2022 and is set to increase further to 18% this year based on IEA's latest projections. The overwhelming majority of electric car sales to date are mainly concentrated in three markets: China, Europe, and the United States. An ambitious policy programs mean that by 2030, the average share of electric cars in total sales across those three markets is set to rise to around 60%. I personally think that is quite optimistic, but time will tell. Staying with renewable energy, offshore wind in the North Sea already powers 25 million European homes and has the potential to meet Europe's entire electricity demand 6 times over. Asia is a relative bright spot amid the rockier recovery of the global economy. As the chart of this week shows, the region will contribute about 70% of global growth this year, a much greater share than in recent years. China's reopening of the economy will provide momentum for the region's growth. The IMF expects the Chinese economy to expand by 5.2% this year. Data from the first quarter have confirmed the forecast of a dynamic start to 2023 with a strong rebound in consumption. And finally, turning to next week, companies reporting next week. On Monday, we have Berkshire Hathaway. Tuesday is Suncor, Great-West Life, Kinross Gold, Northland Power, Element Fleet Management, and SNC-Lavalin. On Wednesday, we have Manulife, Nutrien, Intact Financial, Pan American Silver, Ryocan REIT, Smart REIT, Parex Resources, Ballard, and Peyto. On Thursday, we have Brookfield, Sun Life, Fairfax, Canadian Tire, Algonquin, and Quebecor. On Friday, we have Emera, Canadian Apartment REIT, Crescent Point Energy, Air Canada, and Northwest Healthcare as Canadian Q1 reporting begins in earnest. Looking at economic events next week, on Tuesday, we have U.S. oil inventories. Wednesday is the U.S. CPI, U.S. real earnings. On Thursday, we have U.S. Producer Price Index and U.S. initial jobless claims. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.